Blockchain technology allows you to innovate in the real estate sector more than ever before, turning the least innovative sectors to the most innovative sector. And today, we have a project leveraging perp futures to speculate on the real estate market. And I ain't talking about that type of perp, by the way. Parcl allows you to speculate on real estate markets around the country without having to buy the actual property itself, adding another layer of access to a high barrier to entry industry.
Yeah, the cool thing about Parcl is that it's pretty much a city index. You get to hold futures that represent cities. So like you said, you don't own the actual property, but you own price discovery on that property. And they have cool mechanisms on how they go about determining price and listing everything up to date that we're going to get into. So per usual, y'all know how we do these deep dives. We're going to go through the docs. We're going to go through the tokenomics. We're going to go through their social media, literally everything that we can find on Parcl. We're going to do a website/platform walkthrough at the end. And then at the end, if y'all stick around, we're going to let you guys know if we would buy and or use the platform or not, and why.
Yo, folks, remember, this is nowhere near financial advice. We're just giving you financial information. You take it and do what you will.
All right, guys. So without further ado, let's jump straight into the docs and start diving into this project. All right, guys. So Parcl V3 is a perpetuals exchange designed for real estate synthetics. It supports cross-margin perps trading on various real estate markets. LPs add liquidity to a single LP pool per exchange where they take on trader P&L as well as earn trading fees. So let's break that down. So first off, what are perpetuals? So perpetual futures are a form of futures. And, so futures allow you to speculate on the future price of something, whatever that futures contract represents. And a perpetual future, the word perpetual means it never expires. So you are buying futures on real estate that don't expire until you sell it.
And they're usually derivatives, or they are derivatives of the underlying asset, hint, synthetics. And the underlying asset in this case, it's cities.
All right, guys, so let's dive a little deeper here. So this is the risk management and trading section. So we're going to go through a few key points here. They have some cool processes in place that ensures that the peg isn't broken from the underlying asset in the contract, or increase. You never say don't, because anything can happen. So we're going to kind of go through that here. Okay, so the first one is the funding, the liquidity behind the contract. So it says funding keeps markets balanced by taxing the majority side of a market and paying tax to the minority side of the market. Funding flows through the LP pool, so it can be a short-term risk to LPs. So it sounds like each liquidity has to come up with its own liquidity pool. Like on the websites, it shows like cities that are like coming soon and things like that. So if it's coming from the liquidity pool, this is kind of like if you are loaning money out on Aave, or you're supplying funds on Aave. If too many people borrowed and they haven't paid back their loans, there could be times where, and this has happened to me on some Aave forks, or money market forks, there could be times where you can't get your liquidity back until some loans are paid off, right? So it's the same kind of idea here. They're putting the liquidity providers at risk so that the holders of the contracts could be safe.
So with the skew scale, I want to try to explain this very simply. So they use a funding rate to determine the premium or discount in each market. And the funding rate is usually based on supply and demand for that particular market, as well as in the exchange.
Okay, now let's cover their... Thank you, sir. It's got to be all over my armrest. All right, now let's cover their margin system. So it says the protocol uses a cross margin system, and margin accounts can have a maximum of 12 positions. So it uses dynamic initial margin ratio. And then if you go to the bottom, it says here, since accounts are cross margin, an account with positive P&L positions may negate the account's positions that are below their maintenance requirement. In such case, the account's requirements can be met even though the account has one or more underwater positions. So it's basically saying that they have margin on the platform. Where you have margin, you have liquidations, which means, if you're borrowing money and you don't pay it back after a certain loan to value threshold is met, meaning if the value of your debt exceeds your value or gets close enough to your value by a certain threshold that you agree on before you take out the loan, you can get liquidated. but you can open up multiple positions on here and have it so that while you are liquidated, orders are still getting filled, which is really different. I think that's new. I don't know if I've ever heard of that. Have you? Mm-mm. Yeah, so that's pretty cool. And then moving on to liquidations, if an account falls below its total required margin, then it's fully liquidated and collateral posted as its margin to the account is sent to the liquidity pool. So it says Parcl V3 margin is dissimilar for other margin products in that Parcl V3 traders do not borrow an asset on margin, pay interest, and then freely risk the asset in the market. They explicitly borrow potential P&L at the expense of the exchange's liquidity pool. So it's like the liquidity providers are the house on this platform.
So I just want to go back to this, to margins real quick. I'm going to make this section very, very simple. They're essentially saying that by having multiple margin positions, you're hedging against your lost margin. In the event you get liquidated, you're still hedged. Let's say if you buy a Chicago index and it starts to do poorly, but then you buy a New York index and that's doing well. Well, that New York index is hedging the loss in your Chicago index. And I just want to throw in there, guys, this entire platform, extremely risky. It is pure speculation. And the fact that you can use margin while speculating, it just increases the risk profile of the project. So just keep that in mind if you guys do decide to participate in the Parcl system.
All right, and if you click addresses, it gives you all the contract addresses for the exchanges, the markets, like all of the cities they have listed, the price feeds, literally everything. It says they were audited by OtterSec. Normally you click it and the link takes you to the audit, but it took me to the website, so I didn't actually see the audit, but I'm pretty sure they're not lying.
You could just search Parcl right here.
And even when you search Parcl, it doesn't pop up. And this isn't in alphabetical order.
I would say right off the bat, that is a red flag, actually, that you can't find the audit. But they're marketing the audit, which could be very, very misleading.
And it said they did a follow-up audit in 2024. So let us know if you can find that or if we're missing something here. Looking at a few of their socials, their Discord is pretty big. 66,000 members with 5,000 online right now. Pretty good Twitter following as well, 279K. And they get a lot of interaction on here, or at least likes. I wouldn't say interaction. They don't have a crazy amount of comments. But nonetheless, 279,000 followers is still good. So if we go to parcellabs.com, this is like a different website here. You click research. They have like a few blogs and stuff that they wrote on the housing market and stuff like that. And then you go here, we're going to read a little bit of things that they put on their white paper here. And this is where they really dove into how they determine the price of the indexes for the cities. So they go on to give an introduction first about the state of the real estate market. I'll let you guys read that. But then they go on to say, existing data sources that aim to bring clarity to a market have serious shortcomings on how they present information. The most well-known and widely referenced residential real estate metric within the U.S. is the Case-Shiller Index. So the Case-Shiller produces indexes for 20 different metropolitan areas as well as the country in aggregate. However, we contend that the methodology and output for this index is far from ideal. It only looks at specific types of properties, single-family houses, and has obscure data cleaning processes that has presented difficulties when other researchers attempt to replicate it. Even when using an identical data set, has a lag of more than 2 months from when the index is actually published.
Literally all real estate data is a lag, by the way.
Further, the index exclusively considers repeated sales, which excludes a substantial and increasing amount of multifamily home transactions.
So I think that's an interesting approach because there are some times where multifamily and single family could be bifurcated, although they're both residential. Like I think we're in an oversupplied multifamily state right now. And so I wonder how the index would perform if we see massive supply being pushed onto the market in the multifamily space while we're lacking supply on the single family home side. So I'm just curious how the index would react. I'm going to be monitoring that over time.
Yeah, what they're saying here is that the Case-Shiller Index, how they go about calculating price changes, Like even for just New York, it discards 50% of all transactions in that region.
Because most in New York are, multifamily homes slash like those project style buildings.
So a big percentage of overall real estate transactions get excluded, which, when you're trying to come up with value of something, you want to have as much data as you can. So this is showing here the gap in coverage between the Case-Shiller index and Parcl Labs' novel mechanism for determining the value of these cities. And then you can just look at the number disparities here.
So it says here, the Parcl Labs price feed represents the sole presently available daily estimate of residential real estate price per square foot across multiple markets with varying geographic scopes that include states, metros, cities, etc. And it looks at all of the available transactions in a systematic and standardized way. The Parcl Labs price feed allows users to monitor real-time price fluctuations in their respective markets with minimal delay, with minimal lag, and with an indicator, median price per square foot, that is easy to understand and that can be used to compare more presently with other markets. So I guess that just answered my question and how the index would behave if we saw oversupply multifamily and undersupply and single family. Well, it's kind of an aggregate in a sense that because we're going by price per square foot, it doesn't really matter that, let's say if the market became bifurcated. Being that it's price per square foot will kind of inoculate the index's value if one were to drop, as long as they were to keep it by price per square foot. But that also does raise another question. The price per square foot for single family properties, they're always going to be more than multifamily. And so, let's just keep reading here. This approach represents a significant departure from existing solutions such as the previously mentioned Case-Shiller index, which provides users solely with an index comparing the value of the average home in a given month with the value of the average home in 2000, the most recent baseline reference here. Even if we were able to independently establish the average price of a home in 2000, a user would need to perform unintuitive transformations to get the average price of a home across a given period of time. In the hypothetical scenario where a user can make this transformation, the end result is that the average price of a home in a given market in comparison across different geographies would not be standardized to a metric that allows this type of comparison. A similarly priced condo in New York City is not necessarily comparable to a single-family home in Tampa, Florida, or Washington, D.C. The Parcl Labs price feed addresses this and offers a normalized metric, median price per square foot, that can be compared across markets and that can be used to gauge historical price fluctuations. A square foot of property is the same dimension across all imperial system markets. Future markets accustomed to metric systems will use a square meter as the unit of analysis. So, boom, I guess they just answered my question again. By using the median price per square foot, I guess it takes out those huge fluctuations that we could get because multifamily price per square foot is falling and single family price per square foot is rising, or vice versa. And so using the median at all times and then indexing that to the median, it actually simplifies the entire process. So boom, there you go.
If you look at this chart, they're basically not only accounting for all the transactions, but the data is in more real time, or I'm not going to say real time, but closer to real time. It's not a 2-month lag. And that shows why this line showing the price feed for all these different cities is more bumpy. Because when there's a lag, it just gives you general information. When something is specific, you see in more market changes here, basically.
I.e. volatility.
Yep. So they have bullet points for basically the problems that the Parcl Labs price feed is solving. So they provide an intuitive and easy to understand metric for evaluating residential real estate price movements. They close the gap between county and other administrative real estate records, authorities, and current market conditions, resulting in the first ever real-time tracking indicator of residential real estate. They generate estimates based on all available information within a given market, rather than relying solely on a subset of transactions. They standardize and integrate data from different recording systems to create a single source of truth. They incorporate more timely information, such as listings and other data feed, into the depiction of real estate market conditions. They reduce asymmetries in access to residential real estate data, thereby empowering users. And they offer an index that dynamically adjusts to the velocity and volume of transactions occurring within any given market to provide an unbiased assessment of real estate prices.
So I just want to make a few comments on this. So closes the gap between county and other administrative real estate record authorities and current market conditions, resulting in the first ever real-time tracking indicator of residential real estate. I don't know. In a way, I don't want to say it's misleading, but it doesn't really close the gap. Like if you're indexing with a derivative, so if you create a derivative of an entire city, you still don't have a good insight on the real estate market in that city. Like let's take Florida, for example. You got markets in Florida like Tampa, you got Miami. Let's just use Miami, for example. There are parts of Miami that went bonkers, while the less desirable side of Miami, it didn't go bonkers. It just kind of like stayed the same. Let's take downtown Miami. Now, of course, downtown is an extreme example, but I mean, downtown Miami went through the roof in terms of pricing. But there are a lot of neighborhoods in Miami that didn't have much appreciation. We can even take a market like Detroit. The house that I grew up in essentially hasn't appreciated at all. I mean, because of the neighborhood that it's in, like probably a few $1,000s. At one point, it actually lost value. And so this, I wouldn't say that it closes the gap. In a way, it kind of makes the gap a bit larger because you're speculating on an entire city versus gaining a true understanding of the market within that city. Because even in the market within that city, things could be so different by neighborhood to neighborhood. And so it's kind of misleading. And like if you're using a median price per square foot metric to determine the value of the index, maybe I'm tripping, guys. Maybe I'm tripping. It is late over here right now. It's very late. It's like 11 p.m. But I just don't see how that really helps, let's say, an institution. That doesn't help an institution understand the market more. It would actually skew the understanding of the market a bit more. Because if you're in real estate, you know what I'm saying here, because things could be so different from street to street. And so the fact that they're saying that they close the gap, I feel like that's it's a little misleading. You can never truly get rid of asymmetries in real estate data, market by market. There are always going to be asymmetries because each transaction is done by someone who's working with someone else who's also working with someone else. It's not like this standardized thing where it's like, oh, these transactions are taking place. There are certain neighborhoods in, let's take Arizona, for example, where it's like one listing in that entire neighborhood, especially a few years ago when supply was at its lowest. And so once again, I feel like this would actually skew your understanding of that real estate market. And you would think that it's doing better than it is because they're going off of a median price per square foot. And you're coupling multifamily with residential, which further skews that understanding of that real estate market because those are two entirely different assets. Even the way people buy is very different. Multifamily, you buy more like a business. If someone's buying that building, it's more like a business. If you're buying single family, it's an emotional buy. So even that alone is different. And this last one here offers an index that dynamically adjusts to the velocity and volume of transactions occurring in any given market to provide an unbiased assessment of real estate prices. Inherently, it's kind of biased. So if you take Miami as an example again, if you only go off the median price per square foot of multifamily and single family, you would think Miami in totality is doing very well. But it's like certain parts of Miami are doing very well, and it's not the entirety of Miami. So yeah, I don't know. That one's a little, all these points they're interesting, but I feel like I hate to say this, but I feel like they're using like, not misleading, but I can't think of the word for it. It's something that's just not sitting right when I read those things. Yeah, maybe disingenuous. It doesn't close the gap. It increases the gap, actually. It almost would have been better if they had, within cities, you could speculate on multifamily or single family. Keep those two things separate because they're doing entirely different things, or they could do entirely different things.
And here they go on to talk about how they go about providing that more real-time approach. So they say, unlike indexes that rely on single-family homes that have been sold at least once, our data universe contains information from new construction, repeated sales, as well as properties with no previous sale information. Further, We include multiple types of housing, such as single-family homes, townhomes, condos, etc., and as such are able to present a more accurate depiction of real estate markets.
But it's not an accurate depiction of a real estate market. It's really not. It's really not. And for my real estate guys out there, look, even though you see a townhome, it's still a single family home. It's within the single family sector. And a lot of the times unless there's a strong HOA, they're gonna operate pretty similarly. Condos are a bit different. People don't generally like to work with condos because the value doesn't increase as much in condos. And so I wouldn't say it's a much more accurate depiction of real estate markets at all, actually. Like at the end of the day, what it is an index of all residential living spaces in a city, which you'll have one number as the outcome of a specific data set, but that doesn't help you understand the market better at all. It really doesn't. It's just, you're essentially just speculating on the city. That's it.
All right, guys, now let's go through the tokenomics. So, we went through the platform and how it works. You guys should have a thesis on if you would buy it just based off on that. But now we're going to take the next step, because it's not all about that. It's about the tokenomics too. The project could be killer, but the tokenomics could be not killer. So we're going to find out. So right now the market cap's 52.2 million, which is really small. But the fully diluted valuation is 430 million, which means there's an extremely small amount of tokens on the market. And we still need another 90-something% of tokens still need to come onto the market. So let's figure out how they're coming onto the market. All right, so if we go to this article, you can see the allocation details. So we have ecosystem fund, community growth and incentives, 36%. Initial community supply was 8%. Early supporters and advisors, 28%. That's a lot. So it goes into the details of all that, but we still need to figure out how all of these tokens are coming onto the market. So it goes to show that here, most of them are coming on to the market. Most of them are going to start getting dumped January 2025. So we have that for the early supporters. We have that for the core contributors, January 2025. And it shows pretty much all of them starting to hike up, except for utility maybe. So, this could be a good trade until January. You might want to look into a short position, depending on how the overall market's doing. So I like these tokenomics up until January 2025. After that, kind of goes downhill from there. Or uphill. In terms of supply issuance. Hopefully you guys get that. See,
that
he
was
gets
funny.
It. All right, now here we are on the website. So they have this trading contest going on where, every month they have some winners, it seems like. I'm not going to connect to that. But you can earn perpetual points. And it's basically kind of gets you in line for the next Parcl allocation. And they have the wallet address winners here. And then they are backed by some pretty good firms. Solana Ventures, obviously. Coinbase Ventures, Dragonfly, Archetype.
And they just completed a partnership with Skybridge. Anthony Scaramucci.
That's huge. That's huge. Talks about all the stuff we went into. Got some FAQs. Now let's launch the app. And you can basically search all of these things here. So since we were talking about real estate, you hit property sales markets. You have Atlanta, Austin, Texas. You hit trade. You can go long Atlanta or you can short Atlanta. And this is where the leverage comes in. You can, determine how much leverage you want to use. And then you have your margin requirements right here, right? This is on Solana. This is our first Solana project we're covering. So you have to have a Phantom wallet. But y'all know me. I don't do nothing on Solana for various reasons.
The Solana head's probably sitting at home yes, whoa, I love this.
Yeah, the fact that they built this on Solana and no other chain honestly makes me question their judgment, if I'm just keeping it a buck. But yeah, you can do this with the
Why would you keep it a type of deer?
So instead of finishing, we gonna venison. Say no.
Jesus. I gotta be honest, guys. I mean, if you were to go short any of these markets right now, it just
maybe people are short-term trading it because it's not too volatile, so you can use a lot of leverage without having to worry about, this shit's gonna go down 50%.
Well, it's not.
Exactly.
It's real estate.
So even if you use high leverage on it and it goes short 2%, you can make some pretty good money. You know what I mean? 7%.
It's fucking real estate. And it's like, there's still a huge supply problem. So it's like, just go long on everything.
So that's property sales markets. They have rental price markets. So they only have 3 here.
So there's another one called Lofty. That project, actually, you can invest in real rental property. But maybe we'll do that one.
Yeah, I was going to say, maybe we'll do that one.
That one's built also on Alcoin.
But for right now, let's not disrespect the Parcl guys. Because they've been working so hard for this. Sorry, guys.
Wonder what's up his ass.
So they have token markets, so it looks like you could just long and short Parcl, Solana, Bitcoin, and ETH. Woot woot. And then Forex. I wouldn't trade Forex on here though, probably. They were in their office like, man, should we just throw Forex on this bitch?
Oh my god.
Throw the euro and the Great British pound on there. Fuck it. That's hilarious, man. And then let's see here, non-trading markets. So these are the ones that aren't live right now if you hit non-trading markets. All right. So for all you guys who stuck around to the end, would we buy this project and or would we use this project or not, and why?
Well, so the idea and the concept itself is extremely novel, and it's, I think, net positive for real estate data tracking. I do think that. But my problem is their language. Not one time did they just say what it is. And what it is, it's allowing you to speculate on real estate markets / cities using futures. And so really, it's a betting market. That's what it is. Let's call it what it is. It's a betting market. You're betting that a market will perform well or not perform so well. And because we have a massive supply problem, shit, right now, you probably just go long for a year. For sure, you're going to make some money on an index like Chicago or maybe not Miami. But on a lot of these indexes, you go long for a year, you're probably going to make money. And even in places like Miami, because we saw values drop 30% a year ago, and that was only a subsector of that particular market. So I'm not even sure in its entirety what that number equated to. I don't think it closes the gap between public courthouses. It closes no gap at all, to be honest. It actually widens the gap by just adding that speculatory side of real estate investing. A lot of their tokens still need to be released, and so that's not too good for the value. We still have majority of tokens still to be released to markets, and so that's not so good in terms of the inflationary effects that that's going to have on the price of each Parcl token. And so for me, I wouldn't use the platform itself to speculate on a real estate market. To be honest, I wouldn't use it, but I would buy it because I know people will use it, because a lot of people do want access to real estate and they don't have the means to do so. And so let's say if someone follows the market on a daily basis, they might feel comfortable enough going and making a long bet, because it's a long bet on a particular market, because they know they can't buy a fucking $500,000 house in that market. And so for that, I will buy and hold the token. Haven't bought it yet, but I would buy it. We'll see. I might change my mind after this video, to be honest, but we'll see. And I would never be a participant in the actual platform itself. But I do like the project. The fact that it's built on Solana, there are a lot of Solana heads, a lot of VCs backing Solana. And so Skybridge is backing Solana. And so I can see them having a substantial value increase. I guess I would just be wary of the inflation effects that the rest of the token supply being released. And so I would buy and hold this one. I would just hodl it. I wouldn't be a participant in the platform.
So for me, it's the exact opposite. I would use it. I mean, not like in a serious capacity, like with a large portion of my portfolio, but shit, if the Olympics or some major event is happening in Chicago, I'll go buy it real quick, make a little gain, trade it. It's already not risky using leverage to, I'm not going to say risky. It's already not super risky using margin on this platform from a price discovery standpoint, not a security standpoint, because anything can happen. We didn't see those audits, right? But like, for example, we live here in San Francisco and the world leaders came to visit and they cleaned the city up for like a week or whatever. If I knew about that beforehand, I knew about this project, I might invest in San Francisco, try to make a little trade, use some leverage. You know, it ain't gonna go nothing up and down 7% in a year anyway. If this major event happens, might be able to get a few points low risk. So that could be cool. Now, I wouldn't buy it because I really question their judgment building this on Solana. You can't have shit real time on a network that go down. Your shit ain't gonna work anyway. Oh, I said it. Sorry. I just don't. After reading all the white papers of the layer ones, there's other platforms where you can get high throughput and fast transaction guys. Fuck. I know we all love Solana because it's cool and they're marketing it cool, but the tech is inferior to a lot of other projects, a lot of them. So I don't think it's a bad choice to buy because it's gonna pump. The market cap's small. You know, it's an RWA. I personally would rather buy Realio, other project we made a video on. So I would use it, but I probably never will. Who knows? Not banking on it, but I don't plan on buying it.
I wouldn't use... I can't say I wouldn't use a derivative platform for real estate because I would. But if it was a bit more granular, I would. And if I did, I would only be long until something changes in the real estate market. There's no point of going short. Unless you're literally a day trader and you're like, you care about that 0.7% over like a week or something like that. And then you leverage up on the short side. That would make sense for you. I wouldn't use it. If I'm dibbling and dabbling in real estate, it's going to be actual real estate and or tokenized real estate, not a derivative index for cities. That's so far removed from the actual real estate. It doesn't make any sense.
Yeah, guys. So that's pretty much it. Hopefully y'all understand Parcl now. There's been a lot of buzz around this project. So, you know, this is actually his idea to do it. So I'm glad we did. Hopefully y'all got value from it. If y'all did, consider subscribing, drop a comment, drop a like. Share with a friend who's interested in real estate on the blockchain, tokenization, stuff like that.
And Anthony Scaramucci, if you're watching this, come on the show, man. Let's chop it up about your love for Solana.
Parcl execs, you guys as well. We would love to have y'all on and talk with y'all.
And Jeff Bezos.
Maybe we missed something, this guy. Maybe we missed something. But with that, we thank y'all for tuning in. And we'll see y'all in the next one.